Hello everyone. In this video I'm going to demonstrate and describe how to calculate the weighted average cost of capital for a firm, and we're going to be using Coca Cola for our example, and we're going to be calculating the weighted average cost of capital for Coca Cola at the end of 2023. I'm using this document that will lay out kind of how to calculate the cost of debt and the cost of equity and where our values come from. I'll also be using an Excel workbook that I'm showing you here, and I'll provide this online for you as well. So the weighted average cost of capital for a firm is the discount rate that we often use to determine the required rate of return on the firm's projects. And we also use this a lot in valuation to determine how much a company's worth based on its expected cash flows, and then discounting it back either at the weighted average cost of capital, which we'll calculate, or the cost of equity, which we'll also calculate for the firm. So this is one way to show the equation for the weighted average cost of capital. In this case, we're only looking at two forms of capital for the firm. We're looking at the equity or common equity capital for the firm, and we're looking at the debt for the firm, or things like bonds or loans that it takes out from the bank. Firms can have other forms of capital that we don't have on here. For example, they could have preferred stock. Most companies in the United States do not have preferred stock, so we're going to leave that off of this one for now. But what this calculation tells us is that our first value here, E, which is the market value of the firm's equity, divided by the market value of the firm's equity plus the value of the firm's debt. So that's going to be the weight of equity here, multiplied by the cost of equity, plus the weight of debt, so the amount of debt the firm has, divided by its total value there, E plus D, multiplied by the cost of the firm's debt. And then we multiply that value by 1 minus the corporate tax rate for the firm, because the firm gets to deduct its interest expense for tax purposes. So it actually kind of lowers that cost of debt for the firm. When I say the cost of debt and the cost of equity, understand that these are not dollar amounts. These are percentages, or we'll also show these as decimals. But and that's really important. I see a lot of people run into that problem where they try to put assign a dollar amount to those values, and that's incorrect. The firm's corporate tax rate is just the tax rate that they pay on, or their effective tax rate that they pay on their income. I note here that the weighted average cost of capital and its components should be based on current expectations and not driven solely based on historic outcomes. And this is going to come into play when we talk about the cost of equity and the equity risk premium, because that's changed a lot. You're going to see that's changed a lot over the past few decades. This also comes into play when we talk about the cost of debt, because at the time that I'm recording this, mid 2024, we've had a lot of changes in the cost of debt for firms and for the government, society in general, over the past decade. And so we're going to talk a little bit about that and why we shouldn't rely so heavily on what it has been in the past. So let's get started here with the cost of debt. The cost of debt can be estimated based on the yield to maturity of a firm's existing bonds. So we can look out, if we're calculating the weighted average cost of capital for a firm today, so let's say we wanted to figure out the weighted average cost of capital for Coca-Cola as of today, then we could go out and we could take a look at its Coca-Cola's existing bonds, and usually we're looking at bonds that would mature in about 10 years. And we could find out what the current cost of debt for Coca-Cola, if they needed to raise funds today for that length of time, what they would be. We can take the rate that the firm is currently paying on its debt. So we could look at the interest rates if a firm currently has loans outstanding, how much they're paying, or the firm's current or estimated bond rating. And that's what we're going to do for Coca-Cola here, because we're not calculating the weighted average cost of capital today. We're actually calculating it as of the end of the year 2023. So let me go out here to the spreadsheet. So we've got our ticker, KO. Oftentimes we look up information online using the ticker symbol for the firm. The firm's name is the Coca Cola Company. The date we're looking at is 12/31/2023. As of that date, the market capitalization, so the total value of Coca-Cola's outstanding equity, if we took the shares outstanding, we multiplied it by the price per share, it was $254,778,780,000. So we rounded that there to the closest million. The total debt that they had on their balance sheet was $44.544 billion. Note that when we say total debt, we're talking about the interest-bearing debts for the firm, not all the liabilities of Coca-Cola. We just want the investor-supplied funds. The effective tax rate for 2023 for Coca-Cola was 17.36%. Since the passage of the Tax Cut and Jobs Act and subsequent legislation from that point in time, the tax rate for corporations, profitable corporations, C corporations in the United States, has been around 21%. So that's something to keep in mind as you calculate that and get that number. As of 12/31/2023, the yield on the 10-year U.S. Treasury was 3.95%, and the credit spread for A1, A+ bonds was 0.92. Now, let me explain this a little bit. So, Coca-Cola's bonds are rated A1 or A+ bonds, depending on the rating agency, for Coca-Cola. The credit spread is the additional return that investors require on that credit rating of a bond above the risk-free rate, above the yield on the U.S. Treasury. Where I got this piece of information, if you go out and you search online for Aswath Damodaran, he maintains a great website. He calculates these credit spreads, and so that's where I got that credit spread. It's actually very close to the difference between the yield to maturity on approximately the 10-year bonds for Coca-Cola and the risk-free rate at the time that I record this. So it's a very good estimate for the cost of debt for Coca-Cola here. So the cost of debt for Coca-Cola we're going to add those two together, so it's the risk-free rate plus the credit spreads, plus the additional return that investors are going to require to buy Coca-Cola's 10-year bonds. The reason why I'm using a 10-year bond rather than a 1-year bond or a 30-day risk-free rate is because, that's 10 years is usually the horizon that we're looking at for an investment or for a capital budgeting project. Different authors and different academics or practitioners will use different values here. So, but that's the number I use, the 10-year U.S. Treasury for the risk-free rate. Let me just make a note of that here. And then I'm just going to, just so you can see this, I'm going to use the formula text, and that'll just show you the value and where that comes from for that 4.87. So we're going to say the cost of debt, or the required rate of return on debt for Coca-Cola, is 4.87% at the end of 2023. Let's go back to the document here. So we have the cost of debt. It's pretty straightforward. We can look up the yield to maturity. If you're looking at the weighted average cost of capital for a firm today, we can go ahead and just look up the cost of the yield to maturity if the firm has bonds outstanding. If not, we can look for a similar bond or a similar company, or we can do what we did here, and that's just to go out and find the credit spread for the bond rating for the firm. The next part is the hard part. The next part is the cost of equity, or the required rate of return for equity. the cost of equity is the rate of return required by investors. Now, it's not the investors in the common stock of the firm. Now, it's not the return that they're probably actually going to get, but it's what they're requiring or what they expect to receive in order to induce them to invest in the firm's stock. There's a number of different ways to calculate the cost of equity. I'm going to demonstrate a couple here. The first one is referred to as the Gordon growth model approach. So the Gordon growth model is a model of pricing stocks, and I've got the equation here that says the price of the stock today, P sub 0, that's the price of the stock today, is equal to the next annual dividend paid for the stock, div 1, divided by the required rate of return for equity minus the growth rate. Another way to put that is the last annual dividend paid, div 0, multiplied by 1 plus the growth rate, divided by the required rate of return minus the growth rate. Now, that doesn't tell us the calculation for the cost of equity. We have to rearrange the Gordon growth model in order to get that. And so that's what we've got here. The cost of equity is equal to the next annual dividend divided by the price today plus the growth rate, or the last annual dividend paid multiplied by 1 plus the growth rate, because that growth rate is the growth rate in our dividends divided by the price today plus the growth rate. So that G for a constant growth stock or a constant growth company is equal to the percentage change in the price of the stock, or the expected percentage change in the price of the stock for the next year as well. So as a stockholder, your return comes from two places: the dividend yield. So if I buy a share of stock today, the company pays a dividend. That's part of my return. I get that dividend payment in the next year. And also the change in the price of the stock, and that's my capital gain. And so my return as an investor comes from the dividend yield plus the capital gains yield, the dividend I receive plus the change in the price of the stock. So what I've got here, it says for a constant growth company, the dividend growth rate is equal to the capital gains yield. What else can we use for growth? Okay, so we're going to start with just using the dividend growth rate as the dividend growth rate as our growth rate for the stock, the dividends and the capital gains yield. So let's go back to the spreadsheet. And what I've got here is I've got the dividends per share for Coca Cola for the past 6 years. And we're going to calculate the dividend, the growth rate for every year. And then we're going to calculate the growth rate for the entire period for this stock. So we're going to calculate the growth rate as equal to the natural log. We're assuming continuous compounding in our returns here, of the dividend for fiscal year 2023 divided by the dividend for fiscal year 2022. And it shows us here that the growth rate for that year was 4.45%. And I'm just going to pull this down now. Not all the way, because if I pull it down here, it'll just give me an error message. But we can see here that we had 4.45%, 4.65%, 2.41%, 2.47%, and 2.53%. So I'm going to put out here method 1. Method 1 is just taking the average of the annual changes. And we can see here that our average growth rate is 3.3%. This is a good long-term growth rate for a company. A constant growth rate should be in that 3%, maybe even less, maybe 2%, probably not much more than 4 or 5% for a firm. If the constant growth rate is too high, we're saying that the firm is going to grow at this rate, the dividends are going to grow at this rate, the price of the stock is going to grow at this rate for a very long period of time. Think about it like a 50-year horizon. Okay? If it's much more than 3 or 4%, it's going to overtake the world. Okay? If it's much less, and it certainly can be, and for a while Coca Cola did have a lower growth rate than this, but the firm in terms of its overall size and impact will actually be shrinking because it's not keeping up with the rate of inflation and the rate of population growth. The other method we can use here is that we can take the change. So I can take the change in the over that 6-year period, and so what I put in here is, and I'll go ahead and use that formula text. So you can see that. So what I've got here is that F2, the value at the end of fiscal year 2023 is 1.84, divided by 1.56, the value 6 years prior, raised to the power of 0.2. And if it helps to make better sense here, we can actually change that to 1/5, because there was 5 years following that. It'll give us the same answer, then -1, and that also is another way to calculate the average annual change, or the annual change in the dividend there. So they're very, very close numbers, 3.30 or 3.36. In the end, that won't have a big impact on the cost of equity that we come up with. So we've got the first portion of that cost of equity calculation, and that is the growth rate. Now we need to figure out the dividend yield. So the dividend yield is going to be the value of the next expected dividend divided by the price today. So to calculate the dividend yield, we're going to calculate the expected dividend for 2024 based on the dividend that we have for 2023 plus the growth rate. And I'm just going to use method 1 here because they're very close to 3.3% or 3.36%. And then we're going to divide that by the stock price at the end of 2023 of 58.93. So that's what I'm going to calculate here. So I'm going to calculate the dividend yield. And oftentimes you'll have the dividend yield as part of the information that's out there about the firm, or the expected dividend yield based on the expected future dividend of the firm. But we're going to go ahead and just calculate it here so you can see how it's done. So I'm going to take my numerator, which is going to be the last annual dividend paid, multiplied by 1 plus the expected growth rate in the dividend, which is 3.3%. That's what we're going to use here. And then I'm going to divide that by the price of the stock as of 12/31/2023, and we get a dividend yield here of 3.23%. So again, we take, and I'll just put that out here, equals the last annual dividend paid, which was $1.84, multiply that by 1 plus the expected growth rate, and then we divide that by the price today to get the dividend yield. So our first cost of equity estimate this is the Gordon growth model approach, or the constant growth model approach. You'll hear it sometimes both ways. would be our dividend yield plus our expected growth rate. Or 6.53%. This model doesn't work very well if the firm is not in that constant growth mode. And Coca Cola, fortunately, is. They've been around for a long time. They've saturated their markets. They grow based on population growth, and their revenues grow along with inflation as well. And so we can use this constant growth model approach with that. There are other growth rates we can use other than that 3% that we talked about before, or that 3.3%, because we could possibly say that the stock price of Coca Cola is going to grow faster than that 3.5%. Because that's what we're saying right now, that is that it's going to grow at 3.5%. If we use that 3.36%, let me just show you what that would look like here. We would get a dividend yield of, and again, we don't want a dollar amount there. We just get the same dividend yield of 3.23%. So again, not changing things much there. And then we would get a cost of equity equal to the 3.23 plus the 3.36. And so it would increase our cost of equity by 0.05%. So not a big difference there. So I'm just going to stick with what we have down here so far. The other growth rates we could possibly use are the expected growth rates in earnings per share. And those are often put out by analysts. In a future video, I'm going to demonstrate how to actually calculate that and do those forecasts on your own. So we're going to not do that right now. We can also use what's called the ROE retention rate multiplied by the retention rate, and that also can give us a growth rate there that is based on the firm investing and retaining earnings and growing based on those retained earnings. For now, though, I'm just going to stick with this first model, the Gordon growth model, and we're going to move on to the second approach to the calculating the cost of equity for the firm, and that's the capital asset pricing model, also known as the CAPM. So going back to the document, let me just answer the question here. What else can we use for growth? Well, we can use analyst estimates for growth. Or ROE multiplied by the retention rate. And there are different calculations for that as well. The second approach we're going to take a look at today, though, is the capital asset pricing model. The idea behind the capital asset pricing model is that investors are rational and they will diversify their investments enough that they minimize firm-specific risk. So the people that created the capital asset pricing model, Sharpe, Lintner, Mosen, they basically said that stock investors are rational. They're not going to put all their eggs in one basket. They're going to diversify appropriately, and so the only risk that matters is a firm's or an investment's sensitivity to macroeconomic shocks or big things happening in the market that are going to affect all firms or all investments. And so, for example, changes in interest rates, changes in inflation, changes in unemployment, changes in oil prices. These are all things that affect most companies and most investments. Now they'll affect different investments differently. So for example, we're looking at Coca Cola here. Coca Cola is probably not going to be that affected by a change in interest rates. It's not going to affect really what Coca Cola does much, and it's not going to affect what their consumers do much if there's a big change in interest rates, because it's like I said before, it's a very mature company. It's fully saturated the market, so probably not going to be affected very much by that. But think of a large bank. Think of Bank of America. Bank of America is sensitive to changes in interest rates because it very much affects the desire of investors to either put money in the bank or to borrow money when there's a change in interest rates. And so that one would have a higher level of market risk. The way that we calculate the firm sensitivity or the investment sensitivity to market fluctuations is by using what's called the market model. And that's what I've got here. I've got two equations for you here. The first is the one we're going to use to calculate the cost of equity for Coca-Cola. The cost of equity is equal to the risk-free rate plus the beta for the firm multiplied by, and this first item here is the expected return on the market portfolio. And the second one is the risk-free rate. Okay. So together, the expected return on the market portfolio minus the risk-free rate is the equity risk premium, or also known as the market risk premium. And we're gonna take a look at how that's calculated. And then what we do is that we calculate the sensitivity, this beta, which is a measure of the firm's equity sensitivity to market fluctuations. We calculate that using a time series regression, and I'm going to demonstrate how to do that for you. So let's start here. We're going to start with a market model. We're going to calculate that beta. So going back to your spreadsheet, over here on the side, I've got the adjusted stock price for Coca-Cola. The adjusted stock price is the dividend adjusted stock price. Coca-Cola pays dividends, and this is the stock price adjusted for that dividend payment, based on the date that I've got here. And I use the last trading day of the month for each of these prices. And then we've got the S&P 500 index next to it. And we're going to calculate the returns for the S&P 500 index and the returns for Coca-Cola. And then we're going to use the regression function in Excel to calculate that beta. So let's go ahead and calculate the return for Coca-Cola and the return for the market, or the S&P 500. We're going to use the continuously compounded return here. So what we're going to do is take the natural log of the monthly price, or the price at the end of the month, divided by the price at the end of the month for the previous month, just like that. And then I'm going to pull this, well, I'm going to change the format to make it look nice. And then we're going to have over here the return for the market. I'm just going to drag that over. And again, I'll just put the formula text here so you can see the formula that's being put in that cell. Okay. So now I'm going to drag it down. And what I've got here are the prices for the last 60 months, ending at the end of 2023. And I won't use the last one here. If you pull it down all the way, you'll get an error term there. I'll just show you. I'll pull it down just to show you what that looks like. See, you don't want that. So let me just pull it up here. So I have the last 5 years of the last 60 months. There's many methods on how to calculate the beta. I use 5 years of monthly returns. Some places use 3 years of monthly returns. There's some people that use weekly returns. There are some people that use what's referred to as an analyst adjusted beta, and so it's more of a forward-looking beta that is adjusted based on expectations about the change in that beta to future events. But here we're just going to use 5 years of monthly returns to calculate that beta. So now we're going to regress the returns for the firm on the returns for the market. And I'll just pull up that document one more time just to go over that. So this is our market model. We're regressing the firms for the firm, that's R sub I, firms for the return, for each time period T, and so that's a monthly value, on the returns for the market, R sub M, for every month. And our outcomes will show us the alpha. And if we're looking at, this as an investment where, we might be interested to see, is it outperforming the market in one way or the expectation for the market? And one way we do that is by taking a look at that intercept or that alpha for under or over performance. And then we have an error term for each time period out here that is generated from the regression and helps us get some other statistics that I'll show you here in a minute. So out here in Excel, let's go ahead and calculate this. And there's several different ways that we can do it. We can use the slope function to just get the beta if that's all we're interested in seeing. But I'm going to actually go out here to data, and I'm going to go to data analysis. Now, if you don't have data analysis out here, let's go ahead and show you how to get that. So if you don't have data analysis, go out to options, go to file and then options and add-ins. And where it says Excel add-ins, select Go. And you want that analysis toolpack right up here. Go ahead and select that. While you're out there, go ahead and select Solver add-in too if you want. You might find that useful. So I'm going to go out here to Data Analysis. And I want to select Regression. So I'm going to select Regression and select OK. My Y input range, so my Y's are the returns for the investment. And note here that I am highlighting the label as well. I'm going to just select all of my returns there. And my X input range, I'm going to select the market return and all of my returns there. Go ahead and select labels. I highlighted, I included the labels in my values here, so I wanted to go ahead and do that. And I'm going to have it output by a new worksheet. So that's everything I've got here. I'm going to press OK. And so this is what my regression output looks like. So what this means is that we're going to start up here with the R-square. The R-square is the percentage of the variation in the returns for Coca Cola that are explained by the model. So this has an R-square of 34.4%. So that means about a third of the variation of the returns for Coca-Cola are explained by the market model, which might seem a little bit low, but it's pretty normal for an individual stock. The capital asset pricing model does a very good job of explaining the returns of diversified portfolios and does an okay job, or so-so job of explaining the returns for individual stocks. What we're interested down here is a couple things. The intercept. This intercept is the alpha, and we can see here that the alpha, the monthly alpha, is negative 0.00008. Okay, so it's really, really small. The p-value is greater than 0.05, and so for our purposes, the intercept is essentially zero. There is no additional return generated by Coca-Cola in excess of what's required by the market. The market return, or the coefficient on the market return is 0.59026, and we're just going to round that to 0.59. The p-value is 0.0000008, so it is much less than 0.05, and that's kind of what we're looking for there. What that means, a p-value of 0.05 means if that p-value were be equal to 0.05, it would mean that there is a 5% probability that the coefficient here is equal to 0 and is just due to random volatility or random error for the investment. In this case, the likelihood that this is equal to 0 is virtually non-existent, that it is in fact greater than 0 and is statistically significantly greater than 0. So we're going to go ahead and use this. This is our beta. It's 0.59 for the firm. So I'm going to go back out here to the weighted average cost of capital calculation, the capital asset pricing model. I'm going to put in another line here. The beta is equal to 0.59. We have the risk-free rate. Our risk-free rate is 3.95. Now we need to come up with a market risk premium. So let's go out here, or the equity risk premium, sorry. Let's go out here. You can, it goes by both names. I'll use equity risk premium for our example here today. So let's go out here to this spreadsheet ERP. What I've done is I've downloaded the returns for the market, and that's the S&P 500, and the risk-free rate, the required rate of return on approximately 10-year to maturity bonds, treasury bonds for the government. The reason why we use U.S. Treasury bonds is because they're considered to be free of default risk and free of liquidity risk. So default risk is the risk that the investor won't get the money that is agreed upon. Okay, so if you default on a car loan, the bank's not going to get the money that, you know, the payments that you agreed upon. And the idea is that U.S. Treasuries are generally free of default risk because the U.S. government has never defaulted on any of its financial obligations. The U.S. government can tax if they need to raise the funds. The U.S. government can also print more money if they need to in order to raise the funds to make sure that the debts get paid. U.S. Treasuries are also considered to be free of liquidity risk because if I own U.S. Treasuries, I have an active market out there to sell those treasuries into. I'm not having to wait or to market or to do other things that might incur cost or might take time in order to liquidate that investment at its true market value. And so we use that as the risk-free rate. And the reason why we're using the 10-year U.S. Treasury as the risk-free rate is because, again, that's about our investment horizon when we think about capital budgeting projects or we're thinking about investing in a firm. Usually our horizon is about 10 years, and some authors and some practitioners use different values there. So we're going to calculate the market risk premium for every month ending at the end of 2023. The date I have here is 1/1/24. There was nothing trading on that day, but that was the rate that was out there on that day. So I'm assuming that it was the rate the day before as well. So we're going to calculate the market risk premium, which is just going to be the difference between the return on the market or the return on the S&P 500 for that month and the risk-free rate. And then I'm just going to, so I put out here just subtracting one from the other. Now I'm going to pull this down. And And I got this information from Yahoo Finance. It only allows me to pull down data for through the beginning of 1985. And so now we're going to look at different market risk premiums over different areas of time. So I'm going to calculate 10, 20, and 30 years. And the purpose of doing this is to demonstrate to you a little bit why, what we think about when we calculate this market risk premium, and why we don't want to necessarily just use a certain amount of time in the past. So we're going to use 10 years, 20 years, 30 years, and I'm going to multiply the market risk premium. We're going to calculate the average, and then I'm going to multiply it by 12 to get the annual value. So I'm going to start here by taking the average market risk premium for the last 10 years. As of the end of 2024. So we're going to, you see there it says 13 row, 14 row, 15 row. We're going to go to 120 rows, and that's going to be 10 years. And then we're going to go to 240 rows, and then we're going to take 360 rows for a total of 30 years. And we're going to calculate the market risk premium, the annual average market risk premium over that time period. So this will take us down to, there we go, February 1st, 2014. And we're going to multiply this by 12 to give us an average annual market risk premium and this value is actually what you're going to see is pretty high. So what this means is that the average annual return on the S&P 500 was 7.7% higher than the average return on the 10-year U.S. Treasury for the past 10-year period ending at the end of 2023. So think from February 1st, 2014 through January 1st, 2024, the average was that amount. This is a high amount because the risk-free rate, that U.S. Treasury rate, was, in my opinion, artificially low during most of that time. Okay, we're going to see a very different situation for the last 20 years. So here I'm going to put equals average D2, and I'm going to add 120 months to that. So I want D241. Oh, sorry, D241. And then I'm going to multiply that by 12. So now we see a very different outcome. Now we have a market risk premium of, an average market risk premium of 4.39%. And then finally for the 30 years, we're going to put in equals average D2. And we're going to add another 120, another 10 years to that. So it's going to be 361 through D361. And we're going to multiply that by 12 again to annualize that market risk premium. And we get a market risk premium of 3.89%. So let's think about a little bit about what's happening here. This 30 years is going to go back to 1994, And we had in the late 90s, I'm just going to scroll down here so you can see, the late 90s, we actually had fairly high risk-free rates. So here I'm at 87. You can see this is the monthly rate. So annualizing that would put us, at around 8% for our risk-free rate. So we've got, a little bit higher, not as high as we had in the 80s, but a little bit higher rate here in the 1990s, late 1990s, than we certainly did later on. And so we've got three rates here. When we're calculating the cost of equity, our goal isn't to get the highest cost of equity or the lowest cost of equity, but it's the one that we expect for the future. And so looking at these values, we have to take into account, different things about the past. I certainly don't think that I would want to use the 10-year rate, and in part because interest rates have gone back up. That risk-free rate has gone back up from where it was for most of that 10-year period. So we got a big market risk premium here, and in my opinion, because the risk-free rate was artificially low. The 20-year includes a lot of time where that wasn't the case, where we had more normal risk-free rates. And so for my purposes, I'm going to go ahead and use this 4.39% as the market risk premium. This isn't the only way, certainly not the only way, to get that market risk or that equity risk premium. As Waltham and Darren, who I mentioned before, actually publishes a forward-looking equity risk premium every month. So he's a good source to get for that. And there are other people, other practitioners who also calculate this equity risk premium for the market on a historic basis quite a bit. So I'm going to use this 4.39%. And what I want you to remember here is that this is the expected return on the average stock in excess of the risk-free rate. Okay. So I'm going to use 4.39%, and then I'm just going to put down here the risk-free rate, and we're going to use for that the yield on the 10-year U.S. Treasury as of the end of 2023. And let me, I added a cell here, so let me go ahead and add another cell. Or of these. There we go. So our risk-free rate is 3.95%. We got the one source of information for the equity risk premium or the market risk premium is as Waltham and Darren. That's also where we got the credit spread for the A1, A plus bonds. The cost of debt is 4.87%. The cost of equity using the capital asset pricing model is equal to the risk-free rate plus the beta for the firm multiplied by the equity risk premium. So we get a value here of 6.54%. So we actually get two very close estimates, 6.53% using the Gordon growth model, 6.54% for the cost of equity using the capital asset pricing model. This is a happy coincidence. It typically does not look this nice, but that is kind of the outcome we got here, is that we're getting two values that are very close. The last thing I'm going to ask here is, do our values make sense for the cost of equity? If we think about the average rate of return for the stock market over time for the S&P 500, it's generally around 10%, depending on the time period that you look at. The average annual return will fall in the 10 to 11% range. So how does the risk of Coca-Cola stack up against the average stock out there? It's certainly less risky. The beta for the average stock is 1. And so, the beta for Coca-Cola is 0.59 because it is a very large company. It has saturated the market. It is certainly a truly global company. And it sells a pretty straightforward product. Okay, people know what they're going to get when they get Coca-Cola. So it is certainly less risky than the average stock and should have a lower return or lower required rate of return than the average stock because it doesn't fluctuate much. You kind of know what you're going to get when you buy Coca-Cola stock. So does the cost of equity at 6.54 make sense? I would assume that it does. Some investors might want it a little bit higher, but in general, this is a safe stock. Another thing that I look at is how does it relate to the cost of debt for the firm? Another way to calculate the cost of equity for a firm is just to add a premium to its cost of debt. That cost of the premium is usually about 3%, depending on the riskiness of the company. In this case, the cost of debt is 4.87% for Coca-Cola. So the difference between the two is about 1.7%, 1.65%. Not as much as I would generally see, but again, there's maybe not a whole lot of difference in the risk between the debt for Coca-Cola and its equity because Coca-Cola gives off a pretty good dividend yield. Okay, they pay very stable and very stable with stable growth with their dividends, and so the risk of owning the stock for an investor is likely not much higher than the risk of owning the debt for the investor. So I'm gonna feel pretty good about this cost of equity for Coca-Cola. The last step here then is to calculate the weighted average cost of capital. We have a cost of debt estimate. We have the effective tax rate. We have the cost of equity. And we could really use either one of these. They're very, very close in value. So let's go ahead and calculate that. The weighted average cost of capital, and let's just go back to our formula sheet here, our weighted average cost of capital is equal to the value of equity divided by the value of equity plus debt multiplied by the cost of equity. And this E over E plus D is the weight of equity plus D, the value of debt, divided by E plus D multiplied by our cost of debt multiplied by 1 minus our corporate tax rate. So let's go ahead and do that. So we have our weight of equity, our E, our value of equity. I'm going to go up here. So our market capitalization at the end of the year was $254.778 billion divided by that value plus the value of debt, the total debt, multiplied by cost of equity. You can use either one here. They're so close that it really doesn't matter. I'm going to use a 6.54 plus my debt value divided by, and in parentheses, my equity plus my debt, multiplied by my cost of debt, the 4.87%, multiplied by 1 minus the tax rate of 17.36%. And so I get a value of 6.167% for my weighted average cost of capital. And there's the equation for that too, the formula in Excel. I left a few questions out there on the document. I'm going to go back and answer those. But this is a fairly good estimate for the weighted average cost of capital at the end of 2023, and that's really key for Coca-Cola. You know, if interest rates change, the cost of capital for Coca-Cola will change as well. And so we're calculating it for the end of the year there. Let's go back out here. So what is the risk-free rate? So we're using the yield on the 10-year U.S. Treasury. And we can also use the 10-year U.S. Treasury constant maturity rate. They are extremely similar. The calculation is just slightly different. If you use other rates, for example, the 1-year U.S. Treasury rate, for some time periods you have to use that constant maturity rate rather than just what the current yield is for the 1-year U.S. Treasury, just because of when it was available. So what is the equity risk? What is the equity risk premium? Well, up here I have a definition of it. It is the additional return above the risk-free rate that investors are expected to require to take on the risk of the average investment. We calculated it as the average annual excess return above the 10-year U.S. Treasury rate of the S&P 500. And so that is an example of how to calculate the weighted average cost of capital for a firm using Coca-Cola as the example. Please let me know if you have any questions.